I see a lot of familiar faces, so for those of you who've never seen me speak or don't know me, my name is Jimmy Sexton. I'm the CEO and founder of Esquire Group, and it's always a pleasure to come back to Bern. This is where my involvement with FACO got started. This is my very first presentation, so big thank you to Angie and FACO Bern for getting this all started. So I thought we would spend today giving a little bit of an update on tax reform and a couple of developments as it pertains to U.S. taxes and expats. And since we have a pretty small group, I think it would be good to, just keep it open. If you have questions, raise your hand. We'll do a lot of Q&A and try to keep it interactive and hopefully be able to answer some of your questions. I tried to put a picture up here that is kind of representative of how taxes make people feel, rather than just forms or something. So, like with anything, one of my standard jokes, with anything involving U.S. and taxes, first a little disclaimer. This is for educational purposes only. It's not tax or legal advice. If you want tax or legal advice, you're more than welcome to pay me for it. Anyway. A little bit about myself. So again, my name's Jimmy Sexton. I'm the founder and CEO of Esquire Group. I have a BA in business, from what my slide tells me, with an emphasis in finance, a Juris Doctor in LL.M. in international taxation. Esquire Group has 4 offices worldwide in Phoenix, Vienna, Frankfurt, and in Dubai. And those offices mainly service clients in those regions. They're more like geographic hubs. And I specialize in everything from family offices, expats, expatriation, cross-border estate planning. I'm fluent in English and German. So there was a lot of things on the expat wish list for tax reform that did not happen. FATCA is still a law. It did not get repealed. There was not a lot that changed in terms of Americans abroad. Man, I feel really awkward up here. I'm used to like having a podium. I feel. But anyway, citizenship-based taxation was not repealed. There was a lot of talk about implementing a territorial tax regime, which is like what most countries have. If you don't live there, you don't pay taxes there. That was not implemented. For most instances, the foreign earned income exclusion of foreign tax credits is the same. You still have to file an FBAR. You still have to file a tax return. All the FATCA reporting, all that fun stuff. One of the things that's new, there was a law passed, I'll talk about this a little bit more later. There was a law passed a few years ago where the IRS could revoke your passport or deny renewal if you weren't tax compliant. And that kind of, nothing happened with it for a long time. And in February of this year, they actually started revoking and denying passports for the first time. So we'll talk about that a little bit more. The other thing that we'll talk about a little bit more is OVDP, which is the Offshore Voluntary Disclosure Program, that it's going to be ending. And I think that that's kind of an indication that the IRS is kind of taking the position that if you're not in compliance yet, we've given you ample opportunity. So I think we're going to start seeing a shift, and we'll talk a little bit about that. So some of the things that changed with tax reform that I think are positive. They expanded the number of tax brackets, and they also reduced the top bracket and made the income ranges for the lower brackets a little bit bigger. So now the top bracket is for single taxpayers, so for people who are not married, the top bracket is 37%, where it used to be 39.6%. And they also made that over 500,000, where before it was like over 300 and something thousand, if I remember correctly. So the top bracket kicks in at a much higher rate, and as you can see, somebody's making between 82 and 157,500 using the 24% bracket. That used to be in the 30s. So the tax brackets are benefiting, people a little bit. Married filing joint taxpayers, as you can see, the top bracket doesn't kick in until over 600,000. And the 24% tax bracket goes all the way to 315,000. So, I mean, there has been some relief, I think, in most of the tax brackets. The married filing joint brackets would be the brackets that would apply to people who were married to another U.S. citizen or a green card holder. They could file a joint return. If you're married, yeah?
No, please, I think you're about to answer.
Okay, I was going to say, if you're married to a non-citizen or a non-resident alien, you would be what's considered a married filing separate filer. And you can see those income tax brackets here. They're not quite the same as for individual taxpayers, but they're similar. And so the top bracket doesn't kick in until 37%. Let's see.
Can we go back to that slide real quick?
Absolutely. Is there something specific you're looking for off of it?
The second category, 12%.
The 12% is between $9,526 and $38,700. Very well. Okay, so the foreign earned income exclusion, as most of you know, the foreign earned income exclusion is a tax-free amount of money that you can earn when living abroad. That went up to $104,100 this year, up from $102,100. Also, the annual gift tax exclusion, it used to be $14,000 a year that you could basically give to an unlimited number of people. That went up to $15,000. You can also give $152,000 to a non-citizen spouse. So for those of you who aren't familiar with a little bit of gift tax law, normally between U.S. citizen spouses, you can gift an unlimited amount of money back and forth between each other without any gift tax implications. If your spouse is not a citizen, you can only give them up to $152,000 a year without triggering some type of gift tax requirement. So if, for example, this is kind of a common situation, you have a couple that gets married and one spouse owns a house. Let's say it's the U.S. citizen spouse that owns a house, and they want to add the non-citizen spouse to it. If they were to do that, if it's more than $152,000, they need to file a gift tax return. And if that gift goes over their lifetime gift tax exclusion, there would be a 40% gift tax on that. So that's one thing to remember, is the gift tax rules are not the same between two U.S. citizen spouses and a non-citizen spouse. Yes?
Is there, I'm thinking of my father, who's going to be 100 in August.
Wow.
I'm supporting him partially.
Yep.
But I don't consider that a gift, I consider it more support.
So there is is he a citizen?
He's a U.S. citizen.
Okay, so so there's actually an exception from gift taxes. He would be considered a dependent because he would be a family member. There's specific definitions of who a dependent is. But in this case, if you're providing, since he's your father, if you're providing over half his support, he would be considered a dependent, and he would not be considered a gift.
Does it have to be over half the support?
It does have to be over half the support. It would have to be over half the support. But you can also kind of divide that up a little bit and look, because there's certain exclusion to gift taxes if it's for education or medical expenses. So you'd have to take a look at that.
Okay.
Yep. Yes?
I didn't quite follow. Did you say there's a lifetime maximum for the gift tax
Yes.
exclusion?
Yes. So I think now, especially with tax reform, there's not too many people that are going to hit the maximum, but the maximum lifetime gift tax exclusion is now 11.2 million.
Whoa.
So what I wanted to say, so that's actually the next thing. It got doubled. It went up from like 5.5 million to 11.2 million in 2018. And so one of the things that I would just add, just for explanation purposes, so assuming you used none of your lifetime gift tax exclusion, you have the whole 11.2 million available. What would happen is, if you gave your non-citizen spouse, let's say 200,000, right? You're 48,000 over what you can do tax-free. It doesn't necessarily mean that you're going to have to file taxes. Or pay taxes. It means you have to file a gift tax return and report that you're using 48,000 of your 11.2 million. So the IRS can track how much you have left. And if you ever use up the whole 11.2 million, then you would have to pay this 40% tax. Yes?
I'm American, my husband is not, but he still pays American taxes even though we live overseas. So if I give him a gift, does that do me any benefit?
No.
Okay.
It would be more beneficial to you if he gave you a gift. So anyway,
Jimmy?
yes.
Sorry, this is
Okay.
Both our daughters are holding accounts. We recently removed him from all the accounts in the US.
Uh-huh.
Because of tax things, and made arrangements for our daughters to be beneficiaries. So they're gonna inherit.
Of the US accounts,
Of anything US, right.
okay?
So they're gonna inherit everything that now I have there. They are gonna have to pay taxes on that?
Well, what'll happen if you were to pass, the simple answer is, if those assets are worth less than 11.2 million, then no, they won't have to pay any
They don't-
taxes.
Yeah. good.
Yeah, so, that shouldn't be an issue.
Definitely.
All right, so that's the estate gift tax exclusions, the 11.2 million. Expatriation, giving up US citizenship, so there's certain criteria that if you meet those criteria, you would have to pay an exit tax. And there's an exclusion that even if you're required to, let's say you're subject to exit tax, you get a certain amount of gain that would be excluded. So basically what happens, if you're what's considered a covered expatriate, a covered expatriate is if you have a net worth of $2 million or more, you pay an average income tax of $165,000 per year for the 5 years prior to expatriation, or you're not tax compliant, you're considered a covered expatriate. You don't want to be a covered expatriate. What that means is that you have to pay an exit tax, so that you basically get taxed as if you cashed in any life insurance or pensions or anything on the day before you expatriated, and you have to pay tax on that. And you are taxed as if you sold everything you owned on the day before expatriating, and you have to pay tax on that gain. However, there is a gain exclusion, so if the gain doesn't exceed this $713,000, then you wouldn't have to pay any tax. So that's what this gain, the covered expatriate gain tax exclusion is. And the way you calculate the annual net income tax, so average net income tax, so like I said, there's 3 criteria for being a covered expatriate: net worth of $2 million or more, or having an average net income tax of $165,000 for the 5 years prior. So basically what you do, you would add up all of the income tax you paid for the 5 years prior to expatriation, divide it by 5. If that number is 165 or more, you would be a covered expatriate. Yes?
That doesn't mean those of us who've already left are in this category.
It depends on when you left. Well, it depends. So expatriate means you gave up your passport,
Oh, never mind.
not just not living in
Okay.
the U.S.
Never mind.
Yeah. And then the passport revocation or denial. So basically what happens if you have a tax debt over a certain amount, and we'll talk about this in a little bit more detail, that's when they can deny your passport. And when they can do that is when you have what's called a seriously delinquent tax debt. And so that used to mean $50,000, and now it's up to $51,000. Yes?
Can you explain the gain exclusion again?
So the gain exclusion is this, and this relates to expatriation. So expatriation is basically giving up your U.S. passport. And the way it works is this. There's two categories of people who expatriate. There's what's called a non-covered expatriate and a covered expatriate. If you are a non-covered expatriate, you can give up your U.S. citizenship with basically no consequences. You give it up, there's no tax impact, and you're just like any other non-U.S. person. If, however, you're a covered expatriate, then you're subject to an exit tax regime. Whether or not you actually pay any tax depends on some various factors. But the way it works is this. First, you have to determine whether or not you're a covered expatriate. And the way you determine this is, if you have a net worth of $2 million or more, you're a covered expatriate. If you pay this average income tax for the 5 years prior of $165,000 or more, you're a covered expatriate. And if you're not tax compliant for the 5 years prior to expatriation, then you would also be a covered expatriate. So assuming you are a covered expatriate, one of the taxes that you would be subject to is a tax on your unrealized gains. So let's say, for example, you owned a house, you had a stock portfolio, you had these things, and if you add up all those things, you paid $2 million for them. And if you were to sell them today, they would be worth $3 million. So you would have an unrealized gain of $1 million that would be taxed. But from that amount, you would get to deduct $713,000, so you'd only be paying, was that $287,000? You'd only be paying tax on $287,000 rather than on the whole $1 million.
And then for the gift tax exclusion.
Yes,
If you, let's say, invest that gift, then that's also part of your income, right? Assuming that you have interest income.
yes, absolutely, yep, it would be, correct. Okay, so, going back to,
Hi, Jimmy.
yes,
I do have one, a
Sure.
different question along that expatriating category. So I live in Germany.
mhm,
If I wanted to take on and apply for German citizenship, I would be required
to give up the American,
passport.
yep,
Would expatriate tax stuff come into play then?
yes.
It would.
Yep.
Okay.
So anytime you give up your US citizenship, it doesn't matter what the reason is, whether it's by virtue of taking on another citizenship or just because you went in, you had dual citizenship and gave it up, all these things would come into play. I strongly recommend, if that's something you're considering doing, sit down with somebody that knows what they're doing and go through everything. Because a lot of times, and this is something that, you know, and this is just a simple example, but I've had clients, for example, that let's say they're worth $3 million. And that's which is over the $2 million, and that's the only thing that is causing them to be a covered expatriate. Well, if they gift, let's say 1.1 million to their wife, they're only worth 1.9 million, they can be a non-covered expatriate. So there are certain things that, you know, if that is something you're considering doing, just make sure you plan for it properly. And whatever you do, if they ask you why you're expatriating, don't say tax, because they won't even let you visit the US then.